Here in the United States, central bank independence has been an important part of our history from the very founding of the Federal Reserve System in 1913. As former Vice Chairman Alan Blinder had explained, Congress designed the Fed this way because it knew the temptation to interfere with monetary policy was great, and that such interference would be detrimental to society. So Congress tied its own hands, just as Ulysses had himself tied to the mast of his ship as it sailed past the beautiful and tempting but deadly Sirens. Now, the Federal Reserve's governance structure is one important mechanism that preserves its independence. Congress established the Federal Reserve System with 12 regional reserve banks, of which Philadelphia is one. They were overseen by a board of governors in Washington, D.C. Now, this structure grew out of a frustration with the centralized nature of our nation's two previous attempts at a central bank. Both the first and second banks of the United States, whose last vestiges are not far from where we sit today, were highly centralized institutions located in what was then the political and financial center of the nation, right here in Philadelphia. As Congress debated the creation of the Federal Reserve, it did not want to vest too much authority in a single institution. So it created a more decentralized structure with 12 regional reserve banks, each independently chartered, each with its own 9-member board of directors chosen from citizens within their respective districts. Among the responsibility of these directors is selecting the Federal Reserve Bank president, but with that selection subject to the approval of the Board of Governors in Washington. This structure is designed intentionally to insulate presidents and directors from short-term partisan politics. Unlike Reserve Bank presidents, members of the Board of Governors in Washington are appointed by the President and confirmed by the Senate, and are thus directly connected to the political process in the public sector. Congress provided for those Fed governors to serve 14-year terms, intentionally to insulate them from short-term political pressures and to encourage them to take a longer-term perspective on the economy and the financial system. Congress also ensured a decentralized approach to the structure of the Federal Open Market Committee, or the FOMC, which is the primary body responsible for setting and implementing monetary policy. In 1935, Congress gave votes to the 7 governors in Washington, along with 5 of the 12 regional reserve bank presidents on a rotating basis. The 7 governors, the board retains a majority votes on the FOMC, even though all 12 presidents always participate in the discussions. The 12 regional reserve banks give the Federal Reserve deep roots in the nation's communities, which allows the system to better understand various aspects of our economic diversity of our country and to stay in touch with Main Street, not just Wall Street. Reserve banks have branch boards, advisory boards, councils, and other mechanisms to keep them abreast of the events going on in their regions. Thus, presidents bring a rich array of information and views from around the country to help formulate national monetary policy. Congress also made the Fed independent of the Treasury and the administration. The Fed receives no government appropriations from Congress. Again, as a way of depoliticizing the central bank. In fact, the system turns over any excess earnings on its portfolio of securities and loans above the cost of its operations to the United States Treasury. In 2009, the Federal Reserve System returned $46 billion to the U.S. Treasury. Now, being independent, however, does not mean the Fed is unaccountable, nor should it. The Fed is ultimately accountable to Congress and the American people. Having been granted the independence required to implement effective monetary policy on behalf of the country, the Fed, I believe, has a duty to explain and be held accountable for its policy decisions to Congress and the public. The Fed chairman frequently appears before the House and Senate committees to answer questions. He testifies before Congress on monetary policy at least twice a year. And of course, the chairman's recent confirmation hearings at is part of that accountability in public process. The Reserve Bank structure also helps increase transparency by communicating economic and monetary policy objectives and actions through educational outreach, speeches like this one, as well as discussions with their boards of directors and other groups. As a matter of fact, the Fed has increased the degree of transparency regarding monetary policy decisions dramatically over the last 2 to 3 decades. Some of you may remember that in the 1980s, right until the late 1980s, that the Fed even announced what its policy decision was. We publish weekly balance sheets, monthly and quarterly reports, detailed annual financial statements audited by an independent public accounting firm. The GAO also frequently audits many of the Fed's functions, including its supervisory and regulatory functions and its services to the U.S. Treasury. So why is the Fed opposed to the Audit the Fed Amendment? Since 1978, Congress has specifically exempted monetary policy decisions from these GAO audits with good reason. If we politicize monetary policy by removing that exemption, individual members of Congress would have the ability to challenge monetary policy decisions at will. As I noted earlier, such an attempt to politicize monetary policy, I believe, is wrong-headed, and it would ultimately result in less effective monetary policy for the American people. Another frequently mentioned proposal under consideration would politicize the governance of the 12 reserve banks, as I mentioned earlier, making the chairs of the boards of directors or the reserve bank presidents political appointees. Other legislators have suggested eliminating the voting on the FOMC by reserve bank presidents. I hope I've explained that such changes would weaken the regional and decentralized structure of the Federal Reserve and lead to a more centralized, more politicized institution with less effective policy. Where regional reserve bank presidents or chairs become political appointees, they might become more attuned to the political process in Washington that selected them, rather than having a public interest in the broad economic health of the nation and their reserve districts in which they reside. Politicizing these important positions might also discourage some very talented and public-spirited individuals from serving as part of our central bank. Now, am I surprised that these types of proposals are surfacing at this time? Not really. It's natural to rethink our institutions and decisions after such a large financial crisis. Fortunately, such crises are rare. Let's hope they remain rare. But quite frankly, in my view, some of the actions that the Fed took in response to the crisis in order to ensure financial stability blurred that line between monetary policy and fiscal policy, thereby risking our own independence. The Fed lent to some firms that were deemed to be too big to fail and established unprecedented lending programs, many of which were justified under what is known as 13(3) authority. It's a part of the Federal Reserve Act, which allows the Fed to lend to corporations, individuals, and partnerships under, quote, unusual and exigent circumstances, unquote.